Let's now solve question number 4 from our September 2025 examination. This question is on Accounting Standard 14 Amalgamation. Let's start reading. Following is the summarized balance sheet of Blue Limited and Yellow Limited. I'm sorry I highlighted blue also in yellow and yellow also in yellow. Don't focus on the question's balance sheet, come to what's given after. Blue Limited absorbs Yellow Limited. If Blue Limited is absorbing Yellow Limited, Blue Limited becomes transferee, Yellow Limited becomes transferor. Blue is transferee, yellow is transferor. Let's see what do they want us to do. Don't read adjustments, come to the bottom. You need to compute purchase consideration. You need to prepare balance sheet of Blue Limited after absorption. So you are required to prepare balance sheet, and before balance sheet you are supposed to do PC. For balance sheet, notes to accounts will come free. Like if you take idli chutney free, if you do balance sheet, notes to accounts free. They won't ask notes to accounts separately. You're supposed to do it. Anything else that you would want to do other than balance sheet, notes to accounts and PC computation is all working note. It is not the answer, but it is part of the answer. First page of your answer script, balance sheet. Give space. Don't write the format. Second page and third page, you keep it for notes to accounts. Second page for notes to accounts of liabilities. Third page for notes to accounts of assets. Fourth page, PC computation. Anything else that you want to write, write from page 5 and onwards. This is how your strategy should be in the exam. Now let's quickly skim through the adjustments and then see what adjustments do we have. To begin with, they've told 8% debenture holders of yellow are to be paid a 10% discount by issue of 10% debentures at par in blue. This 10% discount is there, no? This is going to be crucial in agreed value computation. Debentures, when it is taken over, it should be recorded at agreed value, not in the books of transferor, in the books of transferee. When we do our NATO computation, agreed value of debentures are to be taken. That is after deducting 10% discount price. I'll make one small star next to debentures also, so that you will know. Here you have debentures, small star. This 8 lakh, I'll deduct 10% and then take in NATO for computing PC. Am I right? Then the next adjustment. Come to the next one. This is also our Drumsully D. Then come to unrecorded asset. This should also be considered in agreed value computation NATO. In agreed value computation in net assets taken over, this should be taken. This unrecorded asset, and it will also come in the balance sheet post amalgamation. Then we have trade payables of yellow included in trade payables of blue. Trade payables of yellow included rupees 1,50,000 payable to blue. So first we'll take Yellow Limited trade payables. Yellow Limited trade payables 4,25,000. Next to this one star. This is payable to blue in blue's trade receivables. This is there. So post amalgamation, in the balance sheet, we need to eliminate mutual indebtedness. What should we eliminate? So this adjustment is indebtedness. Then we have an adjustment on inventory of yellow is taken over by Blue Limited at 10% more than the book value. So this is agreed value computation. Agreed value in NATO for inventory will not be book value. Agreed value in NATO computation of inventory will be 10% more than its book value, because the inventory is taken at a value other than book value. This will end up becoming amalgamation in the nature of purchase. This will not become amalgamation nature of. For it to become amalgamation in the nature of merger, all assets should have been taken over at book value, and purchase consideration should be settled only in the form of equity shares. And one more thing is business should be continued, and reserves and surplus should be taken over. 90% of them should continue. That we can't check. We'll only check whether PC is given in equity shares and not in cash. All assets and liabilities taken over and taken over at book value. So this ended up becoming amalgamation in the nature of purchase. I'll make a note of it in the beginning. Amalgamation is in the nature of purchase. Then what do we have after that? Goodwill of Yellow Limited on absorption is to be computed based on 2 years simple average. 2 years, 2 times of simple average. So basically 2 times is number of years purchase. We need to take simple average of 3 years profits. They've given 3 years profits here. So we'll take 3 years profit. There is some embezzlement of cash, non-operating expenses or exceptional or extraordinary item. See, in computation of goodwill, we'll take the profits, first eliminate the non-operating or extraordinary or exceptional items. Then we'll find the adjusted profits for those 3 years. Take the total, divide it by 3. We'll get the average profit. That average profit, if you multiply by 2 years purchase, that's how we find goodwill under average profit method. Usually we find goodwill as PC and NATO difference. No. Here they've given us information for NATO and they've given goodwill. I'll take NATO, assets at agreed value minus liabilities at agreed value. I'll get net assets taken over. To that I'll add goodwill, what I find this way. That's how I'll find the purchase consideration amount in total, what should be paid by transferor to transferee, blue to yellow. Then what do we have? Property, plant and equipment is to be taken over at agreed value. So they've given agreed value. Agreed value impact in NATO and also in post-amalgamation balance sheet. For which item? PPE. PPE, I'll put one star here. PPE of yellow. Correct, yellow. 31,26,000. That's not the value what we'll take. That's going to change. Any other adjustment? Remaining assets are taken over at book value. Enough damage already done. Though they take other assets at book value, because PPE and inventory is not taken over at book value, this will become amalgamation in the nature of purchase. Lastly, they've told equity shareholders will be given equity shares at a premium of 5%. So I'll take assets at agreed value, everything at book value except PPE and inventory. Total minus liabilities taken over at book value. I'll get net assets taken over. I'll find goodwill under average profit method. Add total PC I get. If I divide it by 100 rupees nominal value plus 5 rupees premium, 105, I'll get number of shares to be issued by Blue Limited to the shareholders of Yellow Limited. I'll find PC. That will finish my first sub question. That PC will be going to share capital, and to the extent you give premium, it will go to security premium in reserves and surplus. PPE inventory at agreed value, current assets at book value, current liabilities at book value. After I eliminate mutual indebtedness, balance sheet will tally. That set is the question for 14 marks. No journal entries in transferor, no journal entries in transferee, nothing. We have debenture adjustment, we have no realization expenses, we have no unrealized profit, we have mutual indebtedness, we don't have statutory reserve. Only D and M, 2 adjustments. Is there statutory reserve in the question? That's also not there. Can we begin? Yes, sir. Let's start with NATO for Yellow Limited. Focus on the second column. So I'll take goodwill will not be considered. Why? Goodwill will do working note and find the new value. That is under average profit method. Take property, plant and equipment. Balance sheet first page, then space for notes to accounts for liabilities and assets. Here, PC under which method? NATO method. Net assets taken over computation, assets taken over at agreed value, beginning with PPE. What is the value of this 31,260 worth of new value to property, plant and equipment, which was 31,26,000? 36 lakh, where is it? 36,44,000. All right, 36,44,500. Then come back. What is the next asset here? Inventory. It is 4,80,000, but we have adjustment. I forgot to put star then. Sorry. It is to be taken over at 10% more than the book value here. Where have they told? Agreed value. Inventory. 10% more. So I would write inventory 4,80,000 alva. How much is 4,80,000 plus 10%? 4,80,000 plus 48,000, which comes to 5,28,000. Next, come back. We have trade receivables. There is mutual indebtedness, but mutual indebtedness will be adjusted in transferee books post amalgamation. Right now, we'll just take 4,65,000 as it is. Trade receivables 4,65,000. Then I have with me cash in hand 31,500. Sir, how do you say 31,500? It is 0.315 lakhs. If you want to multiply with 1 lakh, you will get the same. Cash balance, bank balance. I'll write both of them. Cash 31,500, bank 60,000. Once I take all the assets, now I'll go to liabilities. Liability side, we have to take short-term provision, current liability, trade payables. These 3 liabilities are taken over at book value. We have 4,25,000 trade payable to be adjusted for mutual indebtedness, but that adjustment will not happen in NATO. That will happen post amalgamation in the books of transferee. I told you, debenture issue adjustment, realization paid by transferee, unrealized profit, mutual indebtedness, statutory reserve. DRUMS. Adjustments will happen in the books of transferee, not in the books of. Very nice. Then I would write here deduction of liabilities. I have given little space for that unrecorded asset taken over. Yeah, we'll come there and then write it. Then I'll write our first liability. Shall I write short-term provisions? Yeah, short-term provisions or borrowings? Provisions. Short-term provisions, 32,000. Then other current liabilities. How much? 88,000. Then we have trade payables. How much? Same, 4,25,000. We have debentures to take, which is debentures 8 lakh rupees, but that needs to be taken at a different value. Shall we change the value of 8 lakh and then take debentures? There is an adjustment. No, debentures are taken over a 10% discount. They are redeemed at 10% discount and the new debentures are issued at par. If you want, I'll take one cute working note here. 8% debentures of Yellow Limited, nominal value 8 lakh, less redemption discount of 10% of 8 lakh, which comes to 80,000. If you deduct, you get 7 lakh 20. This is settled by issue of debentures newly in the company at par. So I'll divide it by 100. That will become 7 lakh 20 by 100 is 7,200 debentures of 100 each. Issue is at par. Redemption is at discount. This 7 lakh 20, what you see here, that's agreed value. Oh, sorry. Already agreed value is written here. I'll write here to be lift it. Don't keep it there. To be considered in NATO. Did you understand that it should be considered in NATO? Pakka? In my NATO here, I would write debentures. We have done another working note. This comes to be rupees 7,20,000. Then any other items left here? No, we are left with capital and reserves, which will anyways take in our adjustments. I'm going to say, sorry, that will be settled to the shareholders. I hope you understood this. We have one more liability here. Gratuity fund, 1,30,000. 1,30,000. Gratuity fund, long-term liability, long-term provision. I would write gratuity fund, long-term provision, 1,30,000. All liabilities are done. Only thing that's left is 28 lakh share capital, 67,000 general reserve. That is what is the settlement. Will not take these two items in NATO. I hope you are clear. Entire balance sheet, Yellow Limited done. Adjustment number 1 done. Adjustment number 2, unrecorded asset I should take. What is the value of unrecorded asset? 1,16,000. I would write here unrecorded asset 1,16,000. Anything else left? Adjustment 3 will happen in transferee company in the balance sheet or notes to accounts. Adjustment 4 already done. Adjustment 5 goodwill, I should do it now. And adjustment 6 PPE done. Adjustment 7 done. 8 I should do. So I'm left with only 2 adjustments, 5 and 8. I should compute goodwill. Once I compute goodwill, I'll add it to NATO, what I'll find here. Once I add goodwill, I'll get purchase consideration. This if I divide by issue price, which is nominal value of 100 plus 5% premium, 105. I'll get number of shares to be given as PC. I hope everybody got this. Okay, help me with this. Take the total of assets taken over. Can I say it's 48,45,000? Then we'll take total of liabilities. 7,20,000 plus 4,25,000 plus 88 plus 32 plus 1,30,000. 13,95,000 from 48,45,000. Let's deduct 13,95,000. 34,50,000 becomes net assets taken over. Goodwill needs to be computed. Shall we compute goodwill? Goodwill very clear. Yeah, they have given 3 years profit, some embezzlement of cash Loss is there in one of the year. After deducting that loss, they've given the profit. That's not a recurring profit. That should not affect goodwill. After deducting that loss, they've given the profit. We'll add back that loss. Find the adjusted profit. Add it for 3 years. Divide it by 3. Adjusted profit. Multiply by 2 years purchase. We'll get goodwill. Help me with the years. Year 1, 2, 3. Or they've given years, no? 21, 22, 22, 23, 23, 24. Profit is 4 lakh 50, 3 lakh 90, 2 lakh 35. I'll write the same. 4 lakh 50, 3 lakh 90, 2 lakh 35. What is the adjustment? In 2023, there was an embezzlement of cash by an employee 50, which is already adjusted in profit. Meaning, one employee took 50,000 cash, not salary, embezzlement, stealing, robbery. This 50,000 is already charged to profit. Can I say my 22-23's profit of 3 lakh 90 is after deducting 50?
Yes.
So I will add back 50 to find how much is the profit.
10 lakhs.
Yeah, we'll get 4 lakh 40 after adjustment. I hope you got it. This will be 4 lakh 50 and 2 lakh 35 as it is. Now add all the three profits. This is the total adjusted profit of 3 years. Divide it by 3 years, you will get adjusted average profit. They are supposed to take 2 years purchase, meaning they are expecting this profit to be earned for 2 consecutive years. So I'll multiply it with number of years purchase as 2. Goodwill becomes 7 lakh 50. So to the net assets taken over, I will add goodwill of 7 lakh 50 to find purchase consideration. 34 lakh 50 is net assets taken over. I'll add goodwill of 7 lakh 50. My purchase consideration will become 42 lakh. 100 rupees is nominal value per share. It is issued at a premium of 5. So divided by 105, you will get number of shares to be issued. 40,000. So Blue Limited should issue 40,000 equity shares of rupees 100 each at a premium of 5, making it 42 lakh as PC. We've done PC. All that we need to do now is balance sheet. To do balance sheet, we just need to look at this PC table. This itself is balance sheet. This much is asset. This much is liability. This becomes share capital. And in this only security premium is there. Only point to note is with our trade receivables, mutual indebtedness is there. And with trade payables also, mutual indebtedness has to be adjusted. And debentures, we will not write their debentures, we will issue new debentures. New debentures will be issued in our company, Blue, and that's what we'll write. Can I begin with balance sheet? PPE 36, 44, 500. I'll write it straight away in the balance sheet. I'll take you all to balance sheet now. This is my balance sheet, the first page of our answer script. Don't write anything here. Come to notes to accounts. In notes to accounts, I'll write property, plant and equipment. Have they given our PPE also? Or we can start with the order of the balance sheet given here. We can start with this order. Okay, we'll start with this order. How much is the equity share capital? I'll take a different color. How much is the equity share capital of Blue? Blue Limited's equity share capital is 40 lakh. Take 40 lakh in the calculator. Did you all take 40 lakh? Come to the answer here. In the answer, we issued them shares, no? How much did we issue? 40,000 shares of rupees 100 each. So, add 40,000 into 100 is how much? 40 lakh. 40 lakh, no. You add 40 lakh to this 40 lakh. 80 lakh. So, in my share capital, I would write. Authorized capital, though I don't know. Have they given authorized capital? Not given. Leave that empty. I would write here, paid up share capital, 80,000 shares of rupees 100 each. How much? 80 lakh. In that, no, 40 lakh was there before amalgamation. 40 lakh worth of shares, 40,000 shares are issued in the process of amalgamation, for which I've got non-cash consideration. I have to make the disclosure separately. Out of the above 80,000 shares, 40,000 shares have been issued for consideration other than Pakka. Very nice. I will assume the same is my authorized capital also. I'll assume. Can you leave that empty? Yeah, you could have left that empty. Just that I have written. Come back to the balance sheet. There were 10% debentures. How much? 15 lakh. Take 15 lakh in your calculator. To 8% debenture holders of transferor, we issued some debentures, no? We've done working note. See here, what did we issue? 10% debentures in blue, 7 lakh 20. Add 7 lakh 20 to 15 lakh, what you had in the calculator. We already had 15 lakh worth of long-term borrowing in the form of debentures. To debenture holders of transferor, yellow, we issued 7 lakh 20,000 worth debentures in transferee. If I add 22 lakh 20,000 will become my long-term borrowings. I would write long-term borrowings, 10% debentures. What was there till now? Plus what I issued, 22 lakh 20. Pakka? 15,000 debentures of 100 each, 15 lakh was there. I issued 7,200 debentures of 100 each, two debenture holders of transferor, 7 lakh 20. Together 22 lakh 20. I hope you all got it. Next, after that we have 8% debentures to that company, gone. General reserve. How much was our general reserve? 1,50,000. Did we come across any reserve in this process? First of all, this is not merger for us to take over their reserves. We did not take any. I'll write my general reserve as it is. I'll take my general reserve as it is. Where? In my notes to accounts under reserves and surplus, I will write my general reserve 1,50,000. Don't total notes to accounts. Security premium will be coming. So once that comes, we'll close the notes. Then retirement gratuity fund. How much is ours? 3,45,000. Did you all take 3,45,000 in calculator? And we have taken over their retirement gratuity also. How much is that? Their retirement gratuity fund 1,30,000. Add it together. 4,75,000. I would write in our other long-term liabilities retirement gratuity fund, ours plus theirs, 4,75,000. And that's it. There is no other long-term liability. Easy?
Okay.
Then next item is trade payables. Do you see a star next to it?
Yes, sir.
What does that mean? There is mutual indebtedness to be adjusted. Ours 7,40,000. Theirs, don't take 4,25,000. Just see the NATO ones. Take 7,40,000 in calculator. Come to NATO, whatever you have done. How much is trade payables? 4,25,000. Add 4,25,000. 11,60,000. Okay. I'll write in my trade payables. To begin with, how much? 4,25,000. Correct? Huh? Less mutual indebtedness. How much is mutual indebtedness? 4,25,000 say I should deduct, no? How much is the mutual indebtedness given here? Mutual indebtedness 1,50,000. I'll not say that the complete adjustment is done because I need to eliminate it from trade receivables also. Am I right? 7,40,000, that of Blue Limited, no problem. Of Blue Limited, no problem. Of Yellow Limited, 4,25,000. I eliminated mutual indebtedness of 1,50,000 to take 2,75,000 in the outer column. Now add 7,40,000 plus 2,75,000. We get 10,50,000. Everybody got this? This has to be eliminated from trade receivables also. I hope everybody understood. Then come back. Next item in the balance sheet. Other current liabilities. 1,24,000. No adjustment. And I think we have taken their their other current liabilities also. 88. Just add them together. 2 lakh. 12. I'll write it in other current liabilities straight away in balance sheet. If you want, I can open one notes to accounts. Otherwise, you can write it straight away. 2,12,000. Next, short-term provisions. No adjustment. No star. Our 71,000. There's 32,000. I think 32,000 we've taken in NATO without any change in the value. Check NATO. 32,000 without any change in the value. No need of notes to accounts also. Straight away add them. What do we add? 71,000 and 32,000. 1 lakh. I'll write it straight away in balance sheet. Sir, can we write it through notes to accounts? Yes, you can always do that. 1,03,000. What do we have after that? Balance sheet, liability side, done. Come to asset side. Goodwill. Our 8,75,000 we will write. But their value will not be 1,79,500. We've given new value to it. Take 8,75,000 plus, how much did we find here? Goodwill. 7,50,000. Add 7,50,000. 16 lakh. That will appear as intangible asset. Observe how much is goodwill of Blue Limited? 8 lakh 75. Goodwill of Yellow Limited on amalgamation 7 lakh 50. Together 16 lakh 25,000. Then what do we have after that? PPE. Ours is 35 lakh 65,000. Their PPE was 31 lakh 26, but we won't take it at that value. Take 35 lakh 35 lakh 65,000, and then their PPE 36 lakh 44 500. Agreed value. Add them.
72 9,500.
I'll write it in PPE. PPE of Blue Limited 35 lakh 65. PPE of Yellow Limited 36 lakh 44 500. Together 72 lakh 9,500. Am I right? Then 8 lakh 89,000 our inventory, 4 lakh 80,000 their inventory. There is adjustment. Agreed value is given. Take 8 lakh 89,000 and see the inventory value at which it's been taken over. Add both.
14
lakh 17,000.
I have to open one notes to accounts for inventory because it's taken over at a different value. I have not opened. Can we write straight away in the balance sheet? Help me with the value. If you want, you can actually open one notes to accounts. I hope you understood. Then what do we have after that? Trade receivables 13 lakh 53,500. Mutual indebtedness needs to be adjusted. There is a star. It has to be deducted from Blue Limited's trade receivables, not Yellow Limited's trade receivables. 13 lakh 53,500. I would write here trade receivables of Blue Limited 13 lakh 53,500. Am I right?
Yes, sir.
That of Yellow Limited. Once again, trade payables. Whose trade payables did we deduct? Yellow. Okay, so this has to be deducted from Blue. And Yellow Limiteds will be 4 lakh 65. It will be as it is. And here let's deduct mutual indebtedness of how much? 1 lakh 50.
12 lakh 3,500.
12 lakh 3,500. Mutual indebtedness is deducted from trade receivables of Blue and trade payable of Yellow. And then take the total, you will get 16 lakh 68,500. Got this? Then what do we have after that? Trade receivable adjustment, cash in hand. Our cash, their cash, both are same. 48,500 plus 31,500. I would write cash in hand. Blue Limited 48,500. Yellow Limited 31,500. Putting it together 80,000. And I'll also go to balance with bank. 19,900 our bank balance. 60,000 their bank balance. No adjustment. Literally write bank Blue 1 lakh 99, Yellow 60, together 2 lakh 59,000. Take the total 3 lakh 39. Come to NATO once. I just took trade receivables, I took cash, I took bank. There is an unrecorded current asset to be recorded 1 lakh 16. I would write this unrecorded current asset 1 lakh 16 in other current assets 1 lakh 16,000. By this, I am done with everything in my NATO. NATO is done. Purchase consideration 42 lakh. Equity share capital done. Security premium is not done. 40,000 equity shares are given as consideration. Not at 100 but at 105. 40,000 into 100. I wrote it in share capital here already. Added to this. Now I should write security premium. 40,000 shares into rupees 5 per share. 40,000 shares into rupees 5 per share. How much is that? 2 lakh. That comes to 3 lakh. Now I've done everything. I just have to post the totals from notes to accounts to balance sheet. Share capital 80 lakh. I'll write note number 1 for share capital 80 lakh. So we'll give note numbers and close the notes now. Don't write the balance sheet format first. Do notes to accounts. Whichever item you've done notes, no, that item you write it in balance sheet. If there is some item not there, for example, let's say in this question, other long-term liabilities is not there. You don't have to write. Deferred tax liability is not there. Don't have to write. Write it only if it is there.
Yes,
Got it? Then after 80 lakh share capital, come to reserves and surplus. 3 lakh 50. Note number 2. Reserves and surplus 3 lakh 50. Then note number 3, long term borrowing 22 lakh 20. Note number 3, long term borrowings 22 lakh 20. Then note number 4, other long term liabilities 4 lakh 75. Note number 4, other long term liabilities 4 lakh 75,000. Note number 5, short term borrowings is not there, and trade payables is there. Trade payables is there. How much is trade payables? 10 lakh 15. 10 lakh 15. Let me write here. 10 lakh 15. That's it. Other current liabilities and short term provisions I wrote directly. I wrote them directly. This I can eliminate actually. Correct? Oh, sorry. This should be A. That should be B. Done. Let's go to assets now. Asset side, do we have tangible assets? Yeah, 72 lakh 9,500. I would write tangible assets, note number 6, 72 lakh 9,500. Intangible asset, goodwill. Goodwill of blue plus goodwill arising on amalgamation. Both together, 16 lakh 25. I would write 16 lakh 25. We have trade receivables. I have written inventory directly. We have trade receivables to be written. Trade receivables, we have mutual indebtedness adjustment also. How much is trade receivables? 16 lakh 68,500. I would write 16 lakh 68,500. Cash and cash equivalent is there. 9th one, 10th one. How much is cash and cash equivalent? Cash is 3 lakh 39. Other current assets is 1 lakh 16. 3 lakh 39 and 1 lakh 16. 3 lakh 39 and 1 lakh 16. I would suggest you to do one note for inventory also. But if it is directly available, you need not actually write it. The moment you get confused, open notes to accounts. It would take 10 seconds at max extra. Quickly take the total on the liability side. 1 crore 23 lakh 75,000 on the liability side. Check it out on the asset side. 1 crore 23 lakh 75,000. This is the solution to September 2025 question on amalgamation.